the market now as we have started to play out. But let's go across. We have Alex Muscatelli, who's the Director Economics at Fitch Ratings, to talk to us. Alex, hi, good morning. Given the divergence between the strong GDP and weakening high-frequency indicators, do you believe India is at an inflection point in its growth cycle?
The revision is that we have published in our forecast to 7.4% for the current financial year from 6.9. It doesn't just reflect the strong outturn for the second quarter of the financial year with this 8.2, but that we saw, but also we have confidence that it's not just one-offs that are unwinding, but there is some momentum in growth and this momentum will continue over the months ahead, even if at a slower pace over the next 2 quarters of the financial year. So we still think that growth will be at close or above trend for the next 2 years, although it will slow down slightly. Part of the story is the weak price pressures we have with consumer prices and wholesale prices very weak at the moment. We have a GDP deflator that's low, historically low, and so the difference also between nominal and estimates of real GDP is particularly narrow. So we can imagine there will be some normalization of this over the months ahead, but still in the context of robust growth in real economic activity.
Right, and what are the most impactful next generation reforms India should prioritize?
I think our current assessment of trend growth in India is 6.4% per annum, and it is indeed our forecast for financial year 27. Now, the impact of reforms in India has already informed some of our forecasts. We had the goods and services tax reforms, which definitely will push up to some extent activity and maybe adjust and affect the profile of inflation over the year ahead. Further out, we have had in recent weeks the implementation of labor market reforms. Now, while our assessment of trend growth was published last year, the fact that these reforms have been implemented will provide definitely some upside to our assessment and could result in an upward assessment, in an upward revision of our trend.
We'll pause you there. We'll pause you there, but we're getting live visuals from the RBI governor, and he walks in. But he's just walked in to the RBI on this very critical day when we're going to see the policy announcement come through. But Alex, you said growth is easing and easing towards 6.2% by FY28. Why is that?
We think that, well, growth will normalize to some extent in the sense that we are seeing quite strong growth rates in the current quarter, but the driver of the slowdown will be slightly weaker consumer spending because the pattern of inflation is such that it will recover a bit in the second half of the next financial year, and what that will do, that will put some pressure on real incomes and reduce the pace of growth of consumer spending, and also some of the base effects that of the factors that are boosting things now will subside. So that is from the consumer side. From the investment side, we still see a decent pace of growth for private sector investment. Up to now, it's been the investment picture has been dominated a bit and driven by strong public capital expenditure, but we think there is scope for private investment to to pick up the baton in some respect, with looser financial conditions and with the and especially if the current high levels of business sentiment continue.
Right. Also, Alex, corporate capex has been stable but is beginning to moderate. Is this cyclical or due to concerns globally?
Definitely, obviously, I think some of the economic uncertainty around the world is not helping. But as I said, the combination of some looser financial conditions along the line, we've had a long series. We had 100 basis points of rate cuts by the RBI. We've had other measures to boost liquidity. Real interest rates should come down once inflation picks up. So this combination of factors should support private investment, although there are some uncertainties around that.
Okay, and Alex, the RBI, they've cut the CRR from 4% to 3%. They've injected liquidity. Does that signal a broader easing intent that supports your rate cut call?
I think it does. The fact that GDP growth was so strong in the second quarter may give the RBI some pause for thought, but we still think that the low inflation, the current low inflation, will give the RBI the space for a rate cut on Friday to 5.25%. But we think this will be the trough of the RBI's cutting cycle. And as I mentioned, we see core inflation recovering and the pace of real economic activity staying quite elevated. So yes, one more rate cut, but then we will be that will be the trough.
Okay, Alex, we'll let you go on that note. Thank you so much for coming in and speaking with us. Now, this is a very, very important day, viewers. It's going to, in 15 minutes or so, we're going to get some sense on what the next couple of months in terms of policy could hold and what the RBI stance is with regard to those couple of surprises on inflation as well as growth. But what we'll do is we'll step into a very short break. On the other side, we'll discuss some of these angles with experts before we hear that very, very critical speech.